everyone, I'm Asta Kurana and welcome to Zerodha Varsity videos. This is episode 2 of Crash Course on Warren Buffett's letters to his shareholders. In the previous episode, we talked about how Berkshire Hathaway came into existence, how Warren Buffett met Charlie Munger, in what companies they invested, and initially Berkshire Hathaway was a textile company, how it ended up became an investment company. In this episode, we are going to discuss the year of these letters from 1982 to 1986. And for that, I have my teammates from Varsity, Vineet and Satya. So let's begin. Okay, so Vineet, we are in episode 2. So what was the economic times now and what do we expect from this video?
So this is 1982 to 86. Inflation had come down. In the previous episode, we saw that inflation was really high. Now the inflation has come down, but Warren is talking about some other terms in inflation, social inflation and judicial inflation, specifically with respect to insurance operations. We also talk about other businesses, that being media and textiles. We will also discuss their mergers and acquisitions, the highlight being Nebraska Furniture Mart. All this while Warren was criticizing the rampant mergers and acquisitions that were happening around that time.
Okay.
Now, this was also the time when their unreported earnings had outgrown the reported earnings. And most importantly, Warren Buffett was dismissive of efficient market theory.
Okay, so you said that most importantly, he was dismissive of efficient market theory. Let's discuss that most important thing first. What is efficient market theory?
Let's take this with an example. Say, Asta, you are valuing a company A, and you valued it at rupees 100. When will you go and buy the stock in the market?
Probably when the price is below 100.
Yeah, so you believe that the stock is undervalued in the market, right, that the market is not pricing something and that's why it is undervalued, and then you can invest at maybe 80 or 90 and you can make profit when the price goes up.
Correct.
What efficient market theory states is that all the assets, all the stocks are pricing in all the information that is available. If efficient market theory works, it says that the company A is valued at rupees 100 in the market as well. What does it mean? That you don't have any scope to go and invest and beat the market.
So Warren Buffett was dismissive of efficient market theory. He said that these academicians, by correctly observing that the market was efficient most of the times, they concluded that the market was efficient all the time. And Warren defends his argument by saying, if the market was always efficient, how could he and Charlie spot arbitrage opportunities?
Okay, wait. First, we have to understand what are arbitrage opportunities.
The general understanding of the arbitrage is that there is a price differential for any stock, commodity or currency, and then you can make a quick profit by buying in one market and selling in another market. Say, for suppose a stock which is valued or priced in at 10 rupees per share on NSE, and you can go and sell the same stock at 10.05 on BSE. So you can make that quick profit at less risk. So this is called an arbitrage opportunity. Now, what Warren is talking about is a different type of arbitrage opportunity which comes during a special situations like mergers and acquisitions. So you know that during the mergers and acquisitions, the price that is announced to acquire the company is slightly higher than the current market price of the share.
Correct.
So say suppose there is company A and company B. Company A is trading at about 10 rupees per share. Company B has announced acquisition of company A at 15 per share. Now, soon after this announcement, the company A prices will go up. Say suppose it went up to 12 or 13. Then you can decide to buy at 12 or 13, wait till the acquisition happens and sell to the company B at 15 per share. So the profit that you would get is the arbitrage opportunity that you...
But then Satya, I have a doubt here that if, as you said, that arbitrage is a risk-free profit that you get, if it is so easier, then why don't people actually involve themselves in arbitrage opportunities?
Yeah, it is considered actually very less risky, and apparently Warren has also made a lot of profit using these arbitrage opportunities. I think what is the top risk here in these opportunities? The risk is, what if the transaction or the merger doesn't happen? What if the acquisition doesn't happen? Then you are stuck with that company,
Correct.
the company A. So this transactions not happening can happen with bigger names as well. I mean, you would have recently seen what happened with Z and Sony.
Yes, Z and Sony.
Yeah.
So Warren and Charlie would indulge in such arbitrage opportunities. They were otherwise long-term investors, but occasionally, to satiate the urge of selling their long-term bets, just to avoid selling their long-term bets, they would occasionally indulge in arbitrage trades. Warren is also saying that arbitrage opportunities are now becoming more difficult to come by. Mind you, this is early 80s, 82 to 86 we're talking about. He's saying that yes, the markets are becoming increasingly more efficient, but they're not fully efficient. There are arbitrage opportunities, but not as many.
Okay, you talked about efficient. I want to drive back the point a little when we talked about that he's dismissing efficient market theory, but often he has talked about telling investors that they should invest in index funds. I somewhere feel that there is a slight contradiction here.
Well, not really. Well, Warren is dismissive of efficient market theory because he himself has the time, resources, and acumen to invest, to do stock picking. But he understands that a retail investor may not have time, resources, or the acumen to invest, but they might have the view that their economy will grow in the long term. Now, they can capitalize on this view by buying a basket of securities. They can do that by investing in an index fund. He says, paradoxically, when dumb money realizes its limitations, it ceases to be dumb.
How nicely quoted.
Yeah, but it's a very, very important point, no? That, as a retail investor, sometimes we may not have time and effort to actually go and pick that right stock, right fund manager. As we talk about it, there's also this report called a SPIVA report, which is S&P indices versus active. So what this report talks about is how the active funds have performed against the index funds. So in India also, SPIVA comes up with a report, and as of the latest data available as of October 2023, I'm talking about the large cap funds here. The report says that 93% of the large cap funds have underperformed in the 5-year period. Of course, this number could change if we change the time period as well, 3-year, 5-year. But what you have to really understand is, like, take 100 funds. About 93 of the funds couldn't beat its benchmark, its own
index.
Yes, we know that investing in equity is important to beat the inflation. Passive funds are offering a simple way for us to invest and earn the returns that the equity is providing. I can't re-emphasize the point that you quoted, the Buffett quote, that when dumb money knows its limitations, it ceases to be dumb.
So what I can conclude from this efficient market theory is that Warren Buffett dismissing it makes sense for him, but for a retail investor, as you both said, who does not have time, effort, or to do that detailed research, he is better off investing in index funds or passive funds. So Vineet, I want to pick another point from the agenda that we were discussing, and you talked about reported and unreported earnings. So let's discuss about that.
So before we understand unreported and reported earnings, let's understand how the investment works. You could have a minority stake in a company, or it could be an associate, or it could be a subsidiary.
Okay, but then first we need to understand that, as you said, that there's a minority, associate, and subsidiary. How do we differentiate that what company is actually a minority and so on?
There are definitions for it. And of course, the definitions keep changing as per the accounting standards that you're looking at, because there are GAAP, there are Indian accounting standards. It keeps changing, and also the definitions keep changing, or the accounting treatment changes with the control you have on the other company. But I'm just saying it generally. Say suppose company A and company B, and say company A has about up to 20% shareholding in company B, then company B is considered a minority shareholder for company A. If company A has about more than 20%, to up to 50%, then that company B is considered an associate for company A. Okay. But if company A has more than 50% stake in company B, then it's called a subsidiary. Company B is a subsidiary for company A.
Basically like a majority shareholder.
Yeah.
Yes, so let me support that with the examples that Berkshire Hathaway had. So for them, Washington Post was a minority holding, Geico was an associate, and Buffalo News was a subsidiary.
Okay, but then how were they accounted?
We can take an example also for that. Say company B is having an earnings of about 200 and giving a dividend of 100 rupees. Okay. Now, how are these accounted in company's A's books in 3 different scenarios of minority shareholder, subsidiary, associate, and a subsidiary? The dividends from minority shareholding company will only be recorded in the company's A's books.
Okay.
Now, say, as I said, company B has declared a dividend of 100 rupees, and say company's A share is only 15%. So 15% of 100? 15. Only 15 will be included in company's A's books.
Okay.
That's the first scenario. Take the second scenario where company B is an associate. Say company A has about 40% stake in company B. In this scenario, we'll take the earnings of company B to the extent of which company A has a stake in it.
Okay.
Company B's earnings are 200. It has 40% stake in it. So 200 into 40%, 80 rupees will be included as earnings in company A's consolidated financial statements.
Makes sense.
Now the last scenario, scenario 3, where company B is a subsidiary. Say suppose it has about 70% share in company B. In this case, not just to the extent of the share company A has, the entire earnings of company B will be recorded in company A's consolidated financial statement, which is 200 of earnings will be recorded in company A's financial statements.
But I have a question. Since their stake was only till 70%, but they are recording the entire amount, what about that 30%?
That's a very good question. In the consolidated financial statements, the entire earnings will be taken, but there is also a separate segment that will be shown, which is a minority shareholding, and they will show to the extent of the 30% will be reflected in the minority shareholding segment of the consolidated financial statements.
Okay.
Now coming to the unreported earning bit, the scenario A that Satya explained, where company A has 15% stake in company B. As 15% stakeholder, their share of earnings were 30. Out of 200, their share of earnings were 30. But they recorded what? Only the 15 that they got as dividend.
Correct.
The other 15 went unreported. This is the unreported earning that Warren is talking about. He's saying that they have a lot of investments where this share of unreported earnings has become larger than the 15 reported. Let me highlight that with an example. Let's say you have two companies, X and Y, and you're holding 15% in both. X gives 200 million in profits, but does not give any dividend. Y gives 50 million in profits and gives 40 as dividends. As 15% holder, you will not report anything out of X because it has not declared any dividend, but you will declare 6, you will report 6 in your earnings because that is how much you got as dividend. 15% of 40 million is what you got as dividend.
Correct.
So in the books, perhaps Y looks a better investment because it gave 6 million, but X goes unreported because it has not given any dividend. Here, the intrinsic value has grown a lot. This unreported earning has grown a lot, but what you can report is only the $6 million.
On the face of it, we can't see it, but it's there. So I think the thing especially for a finance student or a research analyst that they need to keep in mind while they are analyzing companies is that if there is a company where there is a minority stake, so you need to keep an eye for these reported and unreported earnings because you might not realize that there is an intrinsic value which is growing and that might go, unseen.
Yes.
Okay, Vineet, so let's come to the related topic and talk about acquisitions. In the previous episode, we talked about 4 parameters that Warren Buffett had laid when he would, want to think about acquiring a company.
Yeah, why don't you enlist those 4 parameters?
Okay, let's revise. Let me revise it for all of us. So the number 1 point was that you need to understand that business. It should be a simple business to understand. The second point was that it should have good earning prospects. The third was that it should have good managers. And fourth was a very important point that it should be available to you at an attractive price.
You got that right, Astha. Since we're talking about acquisitions, let me interest you in a story that's very close to my heart, about a person that's very close to Warren Buffett's heart. And it's a very inspiring story. Nebraska Furniture Mart.
Rose Blumkin, right?
Yes.
Oh, even I have heard of her.
It's a very inspiring story, and Warren keeps talking about her again and again. She's fondly called Mrs. B. She was immigrated to USA in 1919 and she didn't know a word of English when she moved to the US. In fact, she used to learn a few words of English from her daughter. She used to go to school, learn a couple of English words, come back to home, teach her mom, these English words. So Mrs. B has actually learned a few English words from her daughter. After a couple of odd jobs, in her mid-40s, she started a used furniture store. She always wanted to have a furniture store of herself, and she started this store under the basement of her husband's store with an investment of $500. And she used to sell the furniture at deep discounts. I read it somewhere, as per the New York Times obituary for Mrs. B, her business philosophy is sell cheap, tell the truth, don't cheat nobody.
That's a nice philosophy.
Yes, she would sell at deep discounts and still was profitable. But this agitated all the other retailers in Omaha. So the wholesalers stopped selling merchandise to Mrs. B. She traveled to other cities to procure merchandise and continue selling at deep discounts. She was very tenacious in the way she wanted to do business. Around the time, that is late 80s, when Warren is looking to acquire Nebraska Furniture Mart, it is totaling sales of $100 million annually, the largest of any store in the US.
Wow.
And Warren acquired only 90% of Nebraska Furniture Mart because he wanted to leave the 10% for Mrs. B's family. He saw that Mrs. B's son and grandsons had inherited her passion in doing the business. He wanted to retain them in management, which is why he let them have 10% and bought just 90%.
Wow. You know, you both have told such inspiring story of Mrs. B. There is one story that I also remember, which was regarding the retirement age. So Berkshire Hathaway has this policy of retire at 100, that you can't manage a business beyond the age of 100 years old. But since, as we've discussed, the passion that Mrs. B had around her business, especially for her, that policy was waived and she kept working till the age of 103 in this Nebraska furniture, and she finally passed in the age of 105. Nice. So this is definitely an inspiring story. But Vineet, what excites me even more is that how Warren Buffett was coming across such exciting and fascinating business opportunities.
As far as Nebraska Furniture Mart is concerned, it was in Omaha. Warren himself was in Omaha, so he saw the business and he acquired it. Beyond that, he had a lot of connections that he had developed through his own group of Ben Graham followers and also through Catherine Graham's connections through her media business.
You're talking about connections and networking, but the companies that Warren Buffett was investing are public listed companies, right? I mean, he can just directly see it on the exchanges.
No. In fact, Nebraska Furniture Mart was a family-run, privately owned business, and he acquires a lot of similar businesses. In fact, there was Borsheim's, which was run by Mrs. B's own sister. Borsheim sold jewelry at deep discounts. Mrs. B was selling furniture at deep discounts. Borsheim's was selling jewelry at deep discounts.
Family has the same business philosophy then.
Perhaps. And in fact, by doing so, they were the second largest jewelry store in the country, second only to Tiffany's at Times Square in New York.
So what I understand is that public listed company were not the only go-to to find acquisitions, but family businesses and the businesses that he understood were the one that he acquired, maybe which were in his vicinity. Was that it?
Interestingly, Warren also started placing ads in his letters to shareholders for soliciting acquisitions. He knew that his letters were popular. He wanted his shareholders to know that if they have a business or if they happen to know of someone who has a business that Warren might be interested in, Warren was requesting them to approach him. And he had a checklist in these ads. He was saying that these businesses should have at least 5 million of after-tax profits. And a few years later, he also brings it up to 10 million because of the size that Berkshire had. Apart from that, these businesses had to be simple, something that Warren and Charlie would understand. These businesses had to be run by competent management. Warren did not want to supply new management, and that they were available at attractive price. Most importantly, he did not want to indulge in hostile takeovers. It is when these families wanted to sell the business when Warren was interested to buy them.
So ultimately, through the help of his letters, was he able to, acquire such businesses?
Oh yes, he acquired a lot of such businesses. He acquired H.H. Brown, which was a shoe business. He acquired Techheimer, which manufactured uniform for prison guards, and Scott Fetzer, which was in fact in itself a conglomerate of 17 different businesses that ranged from financial services to hand pumps to kitchenware to encyclopedia.
So many acquisitions, no? I think it's a bread and butter for Berkshire Hathaway. Thinking about it, I can't help, bringing up the point of what Ashwath Damodaran, the valuation guru, talked about acquisitions. In various forums, he said that one of the triggers for him to sell a stock is when he sees that a company is entering into a M&A deal. What is that one word that you hear again and again when there is mergers and acquisitions? The reason for mergers and acquisitions.
We generally talk about that energy is coming together, synergy, let's say.
Yeah, synergy. So they say that synergy is nothing but 1 + 1 is greater than 2. That when two different companies join, the output is generally greater than what the individual companies combined together can produce. Right. So that's the synergy effect. So for most of the M&A deals, this is considered as one of the reasons. So Ashwath Damodaran, he was quoting a KPMG report, and he was saying that for most of the companies where synergy is mentioned as the reason for getting into that M&A transaction, the long-term synergies have not been there, is what his point is. And the second concern that Ashwath Damodaran has about these M&A deals is that usually the companies who are acquiring pay a significantly high price than the value of the business that they are acquiring. But look at Berkshire Hathaway, they are prospering with acquisitions.
Surprisingly, Satya, Warren would align with Ashwath Damodaran's views. He aggressively criticized the rampant mergers and acquisitions that were happening around. We know that he was using his letters to his shareholders to educate them. So he would say that if you are invested in a company that engages in any mergers or acquisitions, you have to ask whether they are entering at the right price. If they're paying too high a price, it is basically a dent to the shareholders' capital. Then, who was fostering this M&A? Was it the investment bankers or lawyers or auditors who were fostering this deal because it was going to bring them more fee money? And most importantly, why was the acquisition happening? Was it really value accretive, or was it to fulfill the CEO's wish list of having a larger empire to rule over?
Right.
Now, Astha, do you remember that story of Prince Charming stuck in the body of a toad?
Yeah, the story where the princess will give her kiss to the toad and he will become a Prince Charming. Is that what you're referring to?
Yes, exactly. Warren brings this story up in his letters, and he says that these CEOs think of themselves as princesses, and the target companies that they want to acquire are Prince Charming stuck in the body of a toad. He says that it's their managerial kiss that was going to unlock the value in these businesses and was going to bring out the Prince Charming out of them.
OMG, look at the way it is phrased. I need this level of skill to write my stories.
And Warren says it turned out that most of these acquisitions were basically toads. They were not Prince Charming. There was no value to be unlocked. It was mostly to fulfill the CEO's wish list.
Nice. This also reminds me of another story that Warren Buffett told about the scope of management. He has this very nice style of making people understand with small stories. So he came up with an example where, say you hold about 120 acres of land and you invited your neighbor who is having 60 acres of land to combine that with yours. So you're telling your friend that, or the neighbor that, okay, let's have 50-50 ownership now, but I need the whole control over the property now. Of course, you can have a greater control over the entire land now on what to sow, what to reap, etc. But in this deal, you've actually lost the ownership on your property by 25%. It shrunk by 25% from 120 acres to just 90 acres.
I mean, to be very honest, that was not a fair quid pro quo, I must say. So Vineet, we talked about merger and acquisitions at a greater length, but it sends me back to my school days, because when the concept of merger and acquisition was introduced to us, so the basic that we understood was you pay a higher price because there is a brand value or a goodwill attached to it. So that is what I am reminded of.
Yes, Warren occupied a lot of pages in his letters to shareholders talking about goodwill and goodwill accounting. Now, let's take some time and understand what goodwill is. Why you pay a high price for a business is because you understand that it has some intrinsic value. So goodwill is basically the price you pay for intrinsic value. Now Warren is pointing out the limitations in accounting. Let's take that with an example. Let's say there's a business that you want to acquire. Its net fair book value is 300. You want to acquire it for 500. This is your acquisition price. What is your goodwill here? 200. Now, according to the US GAAP accounting standards of the time, you had to amortize goodwill over the next 40 years. Let's just go 5 years ahead in the future. This business has grown, the earnings have grown, and the intrinsic value has grown further. But you have been amortizing goodwill all these years. Why would you amortize when the business has been growing, when the intrinsic value is growing? So it was criticism like this from Warren Buffett and other experts in valuation and accounting that the US GAAP finally changed accounting standards for goodwill, and they no more amortize goodwill. Now they only test it for impairment every year. If the value has grown, they do not change the value of goodwill. If the value has declined, they impair it in the books of accounts.
In India also, we have the same accounting treatment for goodwill. We test it for impairment every year. But what I really want to talk about, Warren's quality of picking these accounting faults is that We can't deny that Warren is very, very good with numbers. But at the same time, he himself said in one of the AGMs that he is not up to date with accounting standards. Then how could he find faults in the accounting treatment of, of transactions in the businesses? But one thing is, he makes everything so simple. He says that he knows the basics of accounting and he knows the underlying principles. Even with this depreciation, he understood the business really well. He understood the principles of depreciation, and he realized that depreciating goodwill doesn't make any sense. I love how he makes things very, very simple to the basics.
Talking about Warren Buffett and his investments, Vineet, in the previous video you talked about media business, and you said that we'll be talking more about it in the next episode, which is this episode. So what is happening in media business now?
Around this time, between 82 to 86, Berkshire Hathaway is invested in two businesses, Buffalo News, which was a wholly owned subsidiary, and Washington Post, which was a minority holding for them. Towards the end, they also acquired, in 86, they also acquired Cap Cities, which later became Disney. So they had these three media businesses. Warren was very passionate about media because he understood the power of information that media wielded.
His passion for newspapers goes way back. As a child, he used to deliver Washington Post newspapers. No wonder he reads 5 newspapers every day.
So Warren was in general bullish about the media sector, but he says that investing in Washington Post gave him $160 million more than what he would have gained by just investing in the sector. So he was very happy about the investments that he had made, but he's again bringing up the problems that the sector had. How does media make money? By selling ad spaces. At that time, you had newspapers and you had TV channels to sell ads. There's only so much ad space that you can sell. Hence, they had immense pricing power. Now, there was an influx of a lot of new media houses, a lot of new TV channels. So there was an oversupply of ad spaces. Hence, there was price competition. There was an oversupply. So Warren was expecting the prices to go down. Hence, the revenues would go down. So far, the media businesses that he owned had not suffered any losses. They were earning good profits. But Warren is saying that going forward, the profits will not grow at the pace that he had expected. The profits would grow, but not at the rate that was expected. So basically, the net present value of these businesses was going to go down, and also the intrinsic value hence would go down.
I want to understand how the intrinsic value of a business is calculated. Remember, in the first video, you talked about that everything that has put in the business is called the book value, and the potential of the business, what it could earn in future, is the intrinsic value. So I understood the definition, but how is it calculated?
Well, there are a lot of valuation models that you can use to understand a business's intrinsic value. It could be discounted cash flow model, dividend discount model, relative valuation model, asset pricing model, and a lot more. And as an analyst, you might use multiple models and assign weightages to them, but that is beyond the scope of this discussion.
Okay, so let's discuss something which is within the scope of this discussion and which is actually a very big business for Berkshire Hathaway, and that is their insurance business.
Yes, insurance was the biggest business for them. Again, Warren is pointing out a few issues that the business was facing. Like media business, when there was a lot of competition. In insurance also, there are a lot of new players that have come in, and they are backed by heavy capital on their balance sheets. It's not the profits, but it's the capital on their balance sheet that is helping them to sell at deep discounts. Now, this is insurance. Now, let's say there's a policy worth $1 million and you are charging $3,000 per month as premium. It is a justified risk. Warren is saying that the others had started selling it at 50 or 60% discount, let's say at $1,500 or $2,000 per month. Warren said that this price does not justify the risk you're assuming for $1 million worth of risk. So he's saying, last year we sold $1 billion worth of policies. This year we are happy to just sell $150 million worth because we will not assume risk that is not justified. He was willing to let go of 85% of business because, again, they were large enough, they had capital reserves and float that would support their operations in this lull year. And how could he sustain this loss of business in the interim? He's saying that in a few years, when these policies would come calling, those insurers who have sold it at really cheap prices will not have adequate reserves to honor those claims, and they would essentially have to shut shop or be acquired by other businesses. That is when the likes of Berkshire Hathaway and other strong businesses would stand tall, and that is when they would revive and resurrect their revenues and hence the business.
Okay, Vineet, I have a doubt here. I'm not saying that any business should come to a situation of shutdown, but we've seen in cases of banks, in India, we have a deposit insurance which actually takes care if the bank goes bankrupt do we not have a similar body for insurance companies as well?
Well, in the US, they had state guarantee funds, but we don't have a similar structure in India.
I don't think there are any state guarantee funds in India, but there are a couple of provisions and the measures in place because there's a regulator, IRDAI, which is looking after and monitoring the insurance companies in India. They have something called solvency margin. That is, if an insurance company has a liability that is likely to incur of about 100 rupees, then they must be having 150 rupees as assets. So the solvency margin that they have to maintain is, or the ratio is 150%. Not just that, I think as a regulator, it will have its own powers, and the regulator may also ask the business which is falling to transfer the policies to another insurance business that is with good standing.
In fact, this is what Warren calls as social inflation, where one player has gone bad and all the peers in the sector have to pay up for them. If an insurance company goes bad, the state guarantee fund has to pay up for them. And who funds the state guarantee fund, basically? All the other players will have to pay up.
Right.
And another inflation term that he talks of is judicial inflation. So let's say there are a lot of claims that they won't pay up because they don't fit the contract. And these insurance customers then take them to the court. It's not that the court has proven the insurance company liable, but it's just because the company has enough cash reserves, they should pay up. So there's judicial inflation. And if they don't pay up, they are in contempt of court. So they have to honor claims that they were essentially not liable for.
The judicial inflation or the social inflation, I think in one form or the other, it is there in India as well. Coming to social inflation, we have seen, companies, when some of the, big companies, go down or collapse, then there are other companies in the industry that come and, infuse capital to protect them. We have seen something in the case of S Bank also, when it was in doldrums, the SBI and HDFC and other banks infused capital to keep it under good standing.
Having said that, and despite all the problems that insurance was facing, Warren was very confident of his own insurance operations because they were all very well capitalized and all their risks were adequately priced.
Right. We need moving forward with another of the businesses that Berkshire Hathaway had, or Berkshire Hathaway is their textile business. So what is happening in the textile business now?
Well, this was the time they had to shut textile business altogether.
Okay.
We have discussed in the previous episode that it was a problem child. Now, this is the time when the operations cannot go forward until they invest an additional $50 million in the equipment. And Warren is saying that the opportunity cost of investing in this business is way too high. They could invest this same amount elsewhere and make much more money. So whatever remaining equipment that they had, they sold it for just $160,000. A very small percentage of what they were carried on their books. He did not find it sustainable to carry it forward, hence they had to shut down the textile business.
You will understand how difficult the decision of shutting a textile business is for Warren by reading his letter, because he says that I don't want to close the business just for the suboptimal profits that it is giving. I could continue with it, but he's saying that but Adam Smith, who is considered the father of capitalism and who believes in free markets, he wouldn't agree with it. But there is also one more thing. On the other hand, there are other companies in the holding company that are funding this ending losses operation, which is the textile business. I don't want to continue with this also, but Karl Marx, who is considered a socialist, would not agree with it. He says that the middle ground is the only position that he feels comfortable.
So textile business is all done and dusted for Warren Buffett and Berkshire Hathaway. It must look like an end of an era for Warren Buffett. And it just made me realize that he is not managing any business anymore.
That's true.
No, but he still has insurance business, no?
No. All these were subsidiary operations. All the businesses were run by efficient managers. Warren did try to run the insurance business a few years back, but he realized that he was not good at it and he had taken some undue, unjustified risks. So now he depends on competent managers and just overlooks Berkshire Hathaway.
Since he is not actively managing any business, this leaves him with two important jobs at Berkshire Hathaway, which is hiring people and capital allocation. When it comes to hiring people, as you said, he wants to acquire a company with already good management. He doesn't want to, look for a good management for the company. But of course, if the management moves out, it is his job to look for a good talent. He also says that And he wants to give a free hand to the management all the time because he believes that the better result will come from non-control than control. So, and the other thing is the capital allocation. Now, capital allocation involves, because it's an investment company, the capital allocation decisions are where to invest and what are the allocation decision that will make the return on capital better than before. In fact, so many subsidiary company and all the investee companies that Warren Buffett was holding, he doesn't want the management to retain the cash with the company if he thinks that the company is not making better ROE with the retained capital. He wants the dividend to be repaid to the Berkshire Hathaway so that he can make better decisions. But in contrast, Warren Buffett had never paid dividends, right?
That's true. In fact, it was only in 1965 when they acquired the business. It was in the first year that Warren Buffett declared dividends for Berkshire Hathaway. Never after that did he declare dividends. He wanted his managers to optimally employ capital, and if they did not find optimal options, he wanted them to give it back to Berkshire Hathaway. But he believed that he would always have some opportunities to invest in. So he always retained cash and never paid out dividends.
So they always have opportunity to invest in, right?
Well, they always believed in their ability, but they are seeing some problems because now Berkshire Hathaway is becoming a big organization. They are worth billions of dollars. So it's not easy for them anymore. For example, let's say even 10 years back, they could acquire a business with just 1 million in profits and that would improve their earnings. Now, a 1 million profit in a subsidiary would not move the needle for them. So they are looking for large businesses. Like we pointed out in the ads that he was placing, he wanted these businesses to have at least $5 million and then $10 million in after-tax earnings for them to make any impact on Berkshire's performance.
So we've finally reached to the end of this video. Let's quickly summarize and see what we have learned.
Sure. Firstly, let's talk of efficient market theory, what Warren Buffett dismissed. He's saying that the markets are mostly efficient, but not always. So there are opportunities to do stock picking. But if you're a retail investor, you're better off investing in index funds. Then we discussed M&A, where Warren Buffett is criticizing the way rampant mergers and acquisitions are happening. He wants our shareholders to understand why is it being done, whether it is to add value or to expand the CEO's scope of management, and whether this acquisition is happening at the right price or not. Okay. Then we moved on to Goodwill, where at that time Warren was criticizing the way Goodwill was amortized. Now we see, as is the correct approach, you don't have to amortize, you just have to test it for impairment every year. And in 1985, Warren Buffett finally shut down the textile business because he saw that the opportunity cost of holding on to the business was very high. As an investor, there's a lesson to learn. If you've invested in a stock and its price declines, you have to analyze whether the business also has deteriorated or it's a minor blip. If it has deteriorated, perhaps you should sell it and invest it elsewhere to recover your capital.
Okay, so the learnings that I have from this episode, number one definitely has to be about dividends, because you see Warren Buffett declared dividend only once because he always had better opportunities to invest. So as an investor, when you are investing in a particular stock, you need to look that if the capital allocation is done in a better place, then it's okay if the company is not giving out dividend. But if that is not the case, if capital allocation, they don't know where to do it, then you better look for what is the dividend yield that you are getting from that investment. The second point was around reported and unreported earnings, because that is an important point for finance students and research analysts. You see, when there are companies who are having minority stake or associate stake, it becomes important to see these earnings so that you can understand what is actual intrinsic value of the business. And the third point that I really liked was around social and judicial inflation, because as Warren nicely explained by saying that when one company or one peer falls, it is actually the other peer who have to, share that burden and help that company to survive. And with judicial inflation as well, maybe you not be legally bound to make that payment, but it is morally good for the business environment.
Okay, the first one for me is a Warren involving in arbitrage opportunities. Though he made a lot of profits from this arbitrage opportunities, which is considered slightly less risky for his stature and the quick profits that he has made from these transactions. But he never let go of the long-term investing that is the core to his investment philosophy. But as investors, we all see so many investing styles, out there. But I think that one important thing that we have to remember is understand what's our core investing philosophy when picking direct stocks. The second one would be how Warren has invested only 90% stake in Nebraska and not 100%. He has left that 10% because he knew that the family has also taken those strides and they could manage the, company a little better, and they will have that passion towards the business. I really liked it, that how he believes in having a better result with non-control than control. It is also important for our investment portfolios also. Instead of looking at it every day and having control over investment portfolios, sometimes we have to just let go of it with periodic reviews. The third one is I love stories, so I really loved the Rose Blumkin's story. It's a very inspiring. She started a furniture store and with so many hurdles, and in a place which is not her home country, without knowing any bit of English, she made that furniture store the top furniture stores in the USA. So that's my learning.
So this was all about episode 2. We discussed the letters from the year 1982 to 1986. See you in the next episode, but before we sign off, do tell us in the comment box what were your learnings from this episode. Happy investing!